can then just watch the recording. So I was explaining that fair value gap. So we've done the source, we've done the breaker. We can take some more questions now if anyone has, but I'm just explaining the fair value gaps and the liquidity voids. So we know that a fair value gap or a liquidity void, this is a 4-hour chart. So technically we could say that this is a liquidity void because how large of a gap in price and so imbalanced. This is a 100 pip move without any price coming near it. So this is why we get a reaction from that level. So if we see here that this is also actually an institutional price level. And again, where are we trading to? This is an institutional price level. So you can see that this, from these two red lines I have here, these thick red lines, that is our liquidity void that has been created over here. Now you can actually see over here at the bottom another fair value gap, price imbalance. So there's two now. So this one hasn't been filled. You can see that price basically tested it but did not fill this gap yet. So like I say, it's not always a case, oh, there's a fair value gap here, it's just going to be filled. It's not like that. We need to see what price is doing to determine if that gap will be filled. So if we see here that, let's just mark up our 800 price level over here. So there's our 800 price level, and I'm just going to put there's our 500 price level. So price had maintained its price above our institutional level of 500, bounced off of it, and now it's trading above our 800. So it's unlikely now we're going to see it coming down into our fair value gap because of the price action that is occurring at these zones, at this price zone. Okay, so we can see here that price then rallied off, and although that is looking like an order block, it's not a really strong order block because of the fact that price rallied up, and then you can see that it was consolidating here. So you can mark it up as an order block, but you can expect it to be broken based on the fact that it's not very strong. This order block over here, however, is a much stronger order block because of the fact that price rallied up, created this liquidity void over here, and basically that is where price rallied from. Okay, so this order block is much stronger
remain much from you
than this order block over here.
You cannot remain, okay.
So when we see a liquidity void like this over here, we can expect it for at least 50%. So the 50% level is probably around that area for it to be filled. And sometimes they will fill the entire liquidity void or fair value gap. Now, like I've said, fair value gaps are small gaps and liquidity voids are large imbalance in price. Okay, so in this case, for this particular price action over here, this was a large liquidity void. Okay, and price closed this liquidity void and then bounced off. Where did it bounce off? Well, you can see that over here we add another institutional level of 500 over here for GU. GU moves very quickly, but still institutional level. Price wicked in, almost testing our order block. Now notice that if you look over there, there's a tiny small fair value gap. Now, although on this specific chart I'm showing you, my broker that I'm showing you this chart on does not close that fair value gap. But this is why our institutional levels are important. Institutional levels are probably one of the most important concepts based on the fact that institutional price levels stay the same throughout, whether you're trading with XM broker, FPS broker, XNES broker, Hot Forex broker, any broker you're trading with, institutional price levels are the same. But when retail traders trade, they mark up support and resistance, and then they add their lines based on what they see on the chart. That is incorrect because all broker price is different. Our spreads are different. Everything about trading is different from each broker. So we are trading price. Price is what we are trading. When we buy and we sell, we are trading price. Okay. So that is essentially why our institutional price levels are so important. And you can see the reaction closing this gap over here and rallying up. Now we know that price likes to either use an order block, rally up or rally down, or a fair value gap, rally up or rally down. Those are good confirmation. So for instance, if you sold at the top over here, let's say we sold at the top, we would want some of this gap to close. So maybe we took profit at our halfway point of our liquidity void, because that, you can see price hesitated over here at the close of this 4-hour candle. You can even see it wicking up, but price hesitated over here, and you could have closed out a good profit if you sold over here. If you go down to the lower time frame, you will see that there is a fair value gap. Okay, so let's zoom out over here. That is that same large liquidity void on the 1-hour chart. And if we trade the 1-hour chart, we will see that this over here is a bearish order block. Okay, and we can see the price retested this order block and bounced off, closing our fair value gap liquidity void and then rallying up from that zone. Okay, so that is a 4-hour chart, and if we follow the institutional order flow, here would have been our source at the bottom. So we know that price was bearish over here and it was continuing down. Okay, and over here would have been our breaker. So we mark that up as yellow. Identify that is our breaker. Oh, so now this has changed. Okay. So this over here is our breaker. This candle here is our breaker. This green candle over here is an order block, and it is responsible for this move into the downside over here. Okay, so that is our breaker. When price closes without a wick, with the body of a candle, we can say that price is now going to go bullish. But we cannot just enter based on the fact that because we know price reacts at certain levels. So we can see here is an institutional price level of 800, and we can see how price reacts off that level. So we don't just buy now because we've created a breaker. We wait for price to come in. So potentially you could have waited for this value gap to be closed, but when you see price action happening and no gap to the downside being closed, an order block being created, we can then wait the price to continue upwards. Okay, so if we follow the institutional order flow, we will know that this over here is an order block. So this candle over here is an order block. Over there, that black candle over there took 2 candles, or at least one, and then the second one to the upside is our order block. Price rallied up, hesitated on the 23,500 level, but maintained the level upwards. So you can see that this is another order block over here. I'll answer, if someone asked a question, I'll answer it now. So again, another order block created over here. We are following the institutional order flow. This order block over here is responsible for this move to the upside. Again, another order block created over here. Notice how there's actually also a fair value gap created over here that has not yet closed. So you can expect price to at some point come and close that gap, but for now our structure has not broken. And you can see if I add my levels, this is our 800 institutional level, and price respected it, and you can see that our order block has been respected over here. Okay, so don't be fooled by the fact that this was an order block, but then when we got to the institutional level of our round number, there was price rejection. So essentially, that is an order block, yes, but it is not a very strong order block because it is failing to push above the institutional round number of 2600, okay? So our stronger order block is our 800 level, and when price rallied down, it closed this fair value gap over here. That's a small value gap. I just said that just now. Closed that fair value gap and bounced off over here and gave us this move to the upside over here. That's not a trend line. I'm just showing you the price action happening. Okay, so it's important to note our fair value gaps is imbalance in price. Our institutional price levels are important because we don't, all of us trade on different brokers, and our institutional price levels is where data or price data will come to. Because it's important, we are trading price. We are buying and selling price on anything, on gold, on oil, on stocks, on pairs. We are trading price. So that is why institutional price levels are important. Let me just see if anyone asks questions. Please explain again how you know that the market will either rally or drop so that you are not caught on the wrong side of the trend. Well, Martin, like I said, so let's just look at the bottom of GU over here. Okay, so I'm just going to clean this chart up over here so that we can see data occurring. So we mark up this over here as our last bearish order block over here. We are following price data downwards. Okay, so you can see that if you draw a retail trend line, price is going down. This is actually just an arrow. I'm showing you that price is going in this direction. So you want to know when to go up. Okay, essentially is you are going to follow the institutional order flow like I've showed you with the source, with the breaker, and that is what is going to tell you that the price is going to change direction. But you cannot just enter based on what is happening immediately. You need to be patient. We are doing it on a 4-hour time frame. If you do it on a lower time frame, you might have more trades and there might be different based on the 4-hour, but the 4-hour is an important time frame. Now I'll show you higher time frames, but this is our last bearish order block that was responsible for this move. Okay, so when price breaks this order block and closes above, okay, on this candle here, so this candle closed above our bearish order block. Okay, we then wait for price to come down from this level. This is an institutional level. We wanted to either test the source or test the breaker, depending on how far away. Remember what I said, that the breaker sometimes can intersect with our source. Okay, so let's just make this yellow so we know this is our breaker. So our source and our breaker like to intersect, and that gives us good trade probability because when price comes in, it can then test our source and our breaker when they are intersecting. But when our breaker is high above here, we need to be patient because we need to wait for price to show us what it's going to do. We don't trade impulsively. We are patient. You let the market come to you. We don't trade FOMO, fear of missing out. We wait, be patient. Okay, and you'll be rewarded. So you can see that this is our source. So we waited for price to either test our source or test our breaker, and essentially it actually did. So here is our breaker, and you can see when price closed above, it traded inside of our breaker, traded inside of our institutional price levels, and then we got another break and we followed the institutional order flow. So you are looking for when it wants to rally or drop, we are waiting for the breaker to be created to change the order flow direction. That is what we are waiting for. Okay, I hope that answers your question. I know it's a long explanation, but that is the most simplest form that I can do it. It's you have to trade and you have to basically do this on your charts to know what to do. You can't just jump in and take trades because you're going to win or lose most of the time. So it's best to wait, be patient. Who else is on here? Anyone else got questions? Speak up, type in chat, type in the...
Hello,
yes, hello.
sir. Where do we put our stop loss and TP?
Okay, this I'm going to cover in another video of, I've showed you basically the order blocks, the fair value gaps. So generally you want to have a trading plan, and that trading plan would consist of, you know, your stop loss value, okay, and what type of trader are you? So are you swinging? Are you scalping? Are you intraday trading? You need to determine who you are as a trader to be able to tell yourself where your stops are. So I personally don't, unless I'm swinging, I don't use generally a stop loss, or I don't take a trade if I don't think a 30 pip stop loss plus my broker spread is enough. So I won't take a trade unless I can establish a 30 pip stop loss on a trade, okay? And generally you want to use the institutional price levels. So for instance, when price goes up and price goes down, okay, now generally what will happen is, let's say our institutional price level is at the top of here, price rejected down, and let's say price then rallied up at another institutional price level over here, okay, but created an order block over here, or a source at the top, okay? So essentially it's created a source at an institutional price level, and what I will look for is, following the order block strategy, following institutional price levels, following fair value gaps, I will then look to either sell here and place a stop within my trading plan of 30 pips at the next institutional price level. So we know that the institutional price levels, like I've showed you in the previous videos, is 800, 500, 200, and then the round number figure. Okay, so not only are those targets, they are also key pivotal points in price action, where price goes to or bounces off or rejects from. That is where price is interacting with how the market makers are moving price. So if you're taking a trade, you would want to look for next order blocks, maybe bullish order blocks or bearish order blocks to target price to take your TP, or institutional price levels or fair value gaps, okay? So like I said over here, let's just clean this up again. So when price over here rallied up, okay, this is now GU, it created this liquidity void over here. So this is a large 100 pip, about 126 pip or so, probably less, probably about 100 or so, liquidity void that has been created here, okay? So when a liquidity void is created, GU tends to like to close 50%, okay? So this is a 4-hour time frame. Now notice how that 4-hour time frame intersects with this bearish order block over here. So this over here is a bearish order block, and again, that is another bearish order block over here, okay? But notice how price closed above, and here is still an order block over here, okay? So forget this order block, and price is respecting this order block. Now, just because the trend, the institutional order flow has changed, that does not mean that these order blocks are not valid anymore. They have not been tested in price. So price hasn't come back up to test these order blocks that were created over here. Only when price tests it and closes above it is the order block violated. Okay, so these are still valid order blocks, okay, until price closes above. So you can see there that there was some reaction off that zone, and you can see this order block I've pulled across, this bearish order block I've pulled across. So when this liquidity void was created up here, it came into this bearish order block at our institutional price level and filled the liquidity void. Now, let's say you've marked up on your chart that that is an institutional price level and this is a bearish order block. Okay, now let's go down to the 1 hour time frame over here and look for a possible entry. Okay, so we've marked up, I'm just going to delete this other one so we don't get confused. So we're back on the 1 hour. We've marked up on the chart our 4 hour time frame, and we know that this large area here, I'm just going to do that on the 4 hour. This large area is a liquidity void, this little pink box over here. And I'm going to go down to the 1 hour and see that liquidity void on the 1 hour. Okay, now we know that this line over here, so I'm just going to make this price line green so we can establish that that is a price level and not an order block. So this two red lines are intersecting with my previous 4 hour order block. So if we zoom out over here, you can see that that is my 4 hour order block over here on the 1 hour chart. And when price comes into our 4 hour order block on the 1 hour time frame, we create another order block over here. Okay, so let's just, for the sake of this, we say that we make it purple. So there is a 1 hour. So now not only do we have a 4 hour, so red 4 hour bearish OB, we now also have a 1 hour purple OB. Colors don't matter, just for the purpose of identifying it is important to differentiate between the colors. So I'm just saying purple. Okay, but it's a purple bearish OB. Sorry, I just forgot the bearish. So that is a bearish OB. Okay, now if you've watched the previous videos, when price data intersects with institutional price levels, a 4 hour bearish order block, a liquidity void, notice it's a liquidity void and not a fair value gap, we can then look for a trade setup here. So what I showed you about order blocks in the previous, I think it was the first video, I told you that a good entry point for an order block is at the 50% level. So this is exactly the 50%. Notice we use the body of the order block, even though we encapsulate the wicks as the order block, we use the body 50% or for our first entry, or the opening candle as our entry. Okay, now notice if you take this entry over here, let's say you take it over here, look how small of a stop loss you are using. Okay, so I mean 25 pips, even if you take it at the top of this OB, that's 40 pips. That's a bit high, but at the high over here, this is 30 pips. This is a good entry for me, although I generally take my entries at the 50% or the opening. Maybe you want to split your entry, so you want to take a 0.20 lot size. You would split it into two positions, 1 0.10 here, 1 0.10 here, same stop loss. So let's say you put your stop loss 1 at 30 pips, and then your second entry over here, 1 at 20 pips. So now you've entered and you take the ride down. Where's your take profit? Well, your take profit can either be one of two things. It can be the next institutional price level, which is 200, or it can be at the close of the liquidity void. So, I mean, if you'd entered this trade, for instance, you could have taken a 100 pip move to the downside, and you could have taken profit either at the 50% of this liquidity void, which is giving you about a 70 pip run, or if you were patient, you could have taken it to the bottom where the gap closes and get about almost 100 pips. Okay. Does that answer your question? It's a long explanation, but that is the best way to explain something. And it's recording, so you can go watch it as many times as you want. Any other questions? Matesh, I see you on here. Do you have any questions? Yes, Martin, you'll get a lot of those aha moments. So,
how's it, Darren?
hello, hi, Matesh.
Good. Now I'm just viewing and recapping on everything that's been taught. Quite informative. No, I don't have any serious questions.
Okay, well, we can actually look over here. So, if we
Okay,
look,
actually,
yeah,
sorry. Oh, while we're on Geo,
yeah,
just a question slightly out of context there. There was a major drop in the market price on the 20th of March. You can see it on your chart at the moment. Yeah.
this
How about on 20th?
this one over
Yes.
here.
No, on 20th. That's me. March.
Of March.
March, yeah. You see the big bearish.
Oh, this one. Okay. Yeah.
Yes, 100%. Yeah. What could have possibly caused that, and is it possible for us to interpret that situation?
Well, looking at the daily time frame, it's a whole bunch of bearish candles. But
Yeah.
while we're trading in a live market environment, so let's just have a look at that then. So let's just mark up this whole chart piece here so we know what we're looking at. And we go down to the 4 hour and let's see what we can see. Okay, so essentially what we're looking at here is a whole bunch of bearish order flow. I mean, for instance, let me just see if I can get a better view over here. So this candle, this bullish order block over here, would have been our breaker candle because that was the last bullish order block before that moved to the upside. Where did it go to the upside? Well, that's basically our 32 round number over there to the pip. Okay, so that's the institutional price level, and now pretty much certain that over here is another institutional price level, 313,200. So that is an institutional price level, and 500 over here, another institutional price level. And you can see how the price is respected on that level. Now, that was the last bullish order block before the move upwards. So essentially, when price comes down and breaks this was the candle that broke over there. So that is the candle that broke our order block and created this breaker. Okay. So now we know that that is bearish. Okay, so if we look here, this is probably an institutional price level of 200. So there, sorry, not that. So that is a price level of 200. That is an institutional price level of 200. Okay, so here is probably our 800 institutional price level of 800. So we can see how price is intersecting over here. Now, although we may have missed the entry and possibly wanted the price to come back up and test not only the breaker, but also the source, because this would have been our source candle. So that would have been our source. And here is our breaker. So generally we see that this breaker and the source are intersecting. So generally when this happens, price doesn't tend to want to go and test again, because if our breaker was, say, for instance, on this candle over here, let's just say hypothetically, price would then want to rally higher and test our source possibly again. Now, it's not to say that our source will always be tested, but we need to wait for price to happen to be able to take the trade. So this is where our institutional order flow was bullish and then it became bearish. So even though we may have missed entering over here, we can still follow the institutional order flow and still get an entry. So let's just mark up this candle over here as our order block over there. And we can see actually that there is a fair value gap over there. And basically to the end, so it basically filled about half of this fair value gap here. Okay, so there's still a remainder of that fair value gap over there, and price then retraced upwards and created an order block. Now I know, Mitesh, you're a bit more advanced than most people here, so you know how to use your Fibonacci retracement. So essentially you pull it from there to there on the lower time frames, 15 minutes, and you could have got an entry at your OTE, you know, but we are following the institutional order flow. So forget the fibs, because I haven't showed most people the fibs. We're following institutional order flow. So there's our first order block. Now what we can do, because we know that not only there we have our breaker, we have our first order block. Here is another order block that was created. We can then look for an entry knowing the order flow is bearish. So let's look at, say, the 1 hour. Let's just zoom out here. And following on the 1 hour, we will just wait until price comes to us. Because we know that price is bearish, we will just create ourselves an order block or a setup. So here is a good setup. Here is a bearish order block, knowing the institutional order flow is bearish. Here is an order block on 1 hour time frame, and we have a perfect 50% retest on that level right there. So like I've showed you all, 50% level or even the opening candle can be your entry. So there's the opening candle of the order block to the move to the downside, retracement back up, either the opening candle or the 50%, stops above, and if we measure that, depending on your trading plan, I wouldn't have taken that specific trade, or maybe I would have 32, probably would have taken it 32 pip stop loss if we include broker spread. So you could have been entered in there, and basically as the trend goes, you can just basically follow the institutional order flow on the 1 hour and the 4 hour, knowing the price is bearish. And the same can be said for when the price goes bullish. So you mark up your order flow on the 4 hour, you've marked up your source, and all you do is you just follow it on the 4 hour, the 1 hour. And when price intersects with other time frames, you just mark that areas up as potential resistance. So when we see price come from this bottom over here, what do we notice over here? What's important here is that that's actually an imbalance in price over there. You can see how imbalanced price is over there. That is an imbalance in price because this big, large move to the downside created a huge liquidity void on that candle. And you can see when price comes back into there, they balance the price and then they go. So to answer your question, Mitesh, you'd follow the source, you'd create your breaker to possibly change the institutional order flow, and then you can use your 4 hour markup for the order blocks, the bearish order blocks, or the bullish order blocks. Use the lower time frame to mark up additional bearish or bullish order blocks, and then later, when you guys learn how to use the fibs, you can also use the fibs, but you don't need to use the fibs at this stage. You can still make good entries without the fibs. The fibs is just additional confirmation of where to take the trade.
Okay, thank you for that. I think it'd be more practical if we use the firms on perhaps 15 minutes, but once you show the guys the operation of it.
Yes.
I'm not sure why, but this conference call has a timer on it, and we have approximately 3 minutes left before it cuts off for us
Oh
again.
yeah, I don't purchase Zoom, so that's actually what.
Okay.
No, unfortunately. Does anyone else have any questions?
Yes, sir. I have a question.
Oh, make it quick. We only got 3 minutes.
All right. So can you please open the daily time frame, please?
On which chart?
On GU,
Okay, yeah.
the daily time frame, yeah. So we can see before previous bearish move, the drop, and before the drop, then the rally. What you're explaining?
This one here.
Yeah, the big move, yeah, the big drop.
Yes.
So there's an order block that was created previously where there was a drop, then a small rally, then the sudden movement down.
Yeah, so this is actually also a fair value gap over there. That's a fair value gap.
Previously on the daily, we can see that there's an order block that was created before the rally, the sudden rally, then the sudden drop.
At the bottom.
No, just before the drop, before the main drop.
Oh, this one.
Yes. Can we consider it as a break of the
yes,
of the
you
main?
can correct. You can consider that, even though it is a daily chart. This is obviously the virus that caused, hectic movements in the market. So if you go look at most chart data compared to from January, it's generally normal, like ups and downs. And then obviously if you go look at most market data, the COVID caused huge spikes in prices. So this is not generally something that happens all the time. But yes, you are correct. On the daily time frame, you can pull this across and mark this up as your breaker for the daily chart. Okay, and this is essentially not only an order block on the daily, it is also a daily source. So these rules still apply on multiple time frames, because time frames are fractal, and what happens on any time frame can happen on other time frames. So that is a source, it's an order block, fair value gap, here's our breaker. So not only now is price coming into our breaker over here, it's also going to close this large fair value gap over here. This was a huge fair value gap over here.
So can we, since I've made to believe that price has to be completed, and we've actually tested it and it's rejected it, can we expect a bearish move to the order block at the fair bottom of the drop?
This one?
Yeah, no, on the previous one that you've already drawn.
This one over here?
Yeah.
Well, I think that you're going to have to wait a couple of months for that to happen, or maybe not, like if there's another COVID or something. But no, I don't think price is going to come there, maybe a couple of months. Because look, we're already in May now, and that happened in March. So that took, 3 months almost to make that